Greetings. Today we are talking about timber casualty losses, what happens from a tax standpoint when timber is damaged by a sudden event like a storm, ice, high wind, or other disaster. For many forest landowners, the hardest part is not just the physical cleanup, it's understanding what records are needed, whether a loss may be deductible, and how salvage income should be handled. We'll walk through basic definitions, the importance of the federal disaster declaration, how a timber basis works, and what questions to bring to your tax preparer and forester. Just to note that this was developed as a workshop for landowners in November of 2025 up in Gaylord, Michigan, and presented by Dr. Karen Potter-Witter, an emeritus professor from the Michigan State University Department of Forestry and MFA's immediate past president. The content focuses on the ice storm that impacted northern Michigan in 2024, but we believe that the content will be relevant to other casualty loss events in the future. Let's start with the roadmap for today. This overview is our checklist. We'll begin with what counts as a casualty loss, then why a federally declared disaster area matters. After that, we'll talk about proof of loss because documentation is often the difference between a useful tax discussion and a frustrating one. Then we'll cover who may claim a deduction, how that's calculated, and why timber basis is so important. And finally, we'll look at filing categories, timing, salvage income, and involuntary conversion. The goal is not for you to become tax experts, it's for you to know what to ask and what records to gather. Before we get into the rules, we need to be clear, though, about the limits of today's discussion. This presentation is educational. It is not legal, financial, or tax advice. Timber casualty losses depend heavily on your facts, how you own the property, whether it's personal use, investment, farm, business property, what basis records exist, whether insurance or other reimbursement applies, and whether your property is in a federally declared disaster area. So please use this as a guide for conversation with your tax preparer or accountant, attorney, and especially your consulting forester. And be very cautious with online summaries, especially those making broad claims about salvage sale requirements because the details matter. So let's define the kind of event we're talking about. A casualty is not just, oh, my woods have changed over time. The IRS definition centers on damage, destruction, or loss from an identifiable event that is sudden, unexpected, or unusual. For Michigan forest landowners, think of an ice storm, for example, that breaks treetops overnight, or a tornado path through a stand, or severe wind throw after a storm. That is very different from gradual decline, normal mortality, insects moving slowly over time, or long-term market changes. The loss also has to involve tangible, measurable property, in this case timber, and it has to be evidenced. In other words, we need to be able to point to the event and document the damage. Once we know there was a casualty, the next question is whether the disaster designation changes the tax treatment. This slide focuses on the Michigan Severe Winter Storm, DR 4880-Michigan, as an example. So a federally declared disaster is one that the President of the United States determines warrants federal assistance under the Stafford Act. IRS publication 547 states that disaster areas include areas eligible for public or individual assistance or both. And this matters because personal use casualty losses are deductible only if tied to a federally declared disaster, while business or income producing property follows different rules, but may still benefit from disaster-related timing. For landowners, the practical takeaway is this. First, confirm whether the affected property is actually in a declared area and whether the event caused the damage. Now let's look at the geography of that particular example declaration. So this is not just background, it's part of your eligibility story. So if your property is outside a designated disaster area, the tax treatment might be different, especially for personal use losses. So in our example, FEMA's Michigan disaster listing identifies DR-4880-MI with an incident period of March 28th, 2025 through March 30th, 2025, and a major disaster declaration date of July 22nd, 2025. For landowners, I would suggest marking your property location, county, and parcel records, and then saving the FEMA declaration information with your tax file. If a forester or tax preparer asks whether your property was in the declared area, you will want that answer ready. Location, though, is only one piece. The other big piece is proof. The IRS says you must be able to show that a casualty occurred and support the amount claimed as a deduction. For timber, that means documenting the storm itself, the date, the affected area, your ownership, and the direct link between the event and the timber damage. This deck lists useful documentation, so photographs, appraisal documents, timber crews, news articles, timber accounting records, management plans, and past tax return. My practical advice is just build a folder: before and after photos, maps, stand records, sale contracts, forester notes, any correspondence you've had with insurance, and any disaster assistance records. Don't rely on your memory 6 months later. Once your records are in place, the next question is who can potentially claim a loss? 3 broad taxpayer categories are business, investor, or personal use landowners. This matters because the forms and the limits are different. So a tree farm operated as a business is not handled the same way as a family hunting property used personally. An investment timberland may be treated differently from a residence with landscape trees. The federal disaster declaration is especially important for personal use property because personal casualty losses are generally limited to these areas under IRS rules. So before calculating anything, just classify how your timber property is held and used. After eligibility, we move to the core calculation: how much, if anything, can be claimed. The basic rule is that the deductible loss is not automatically the market value of the damaged timber. For timber held for business or investment, USDA Forest Service guidance explains that deductible casualty loss is the smaller of the adjusted timber basis, or the decrease in fair market value immediately before or after the casualty. And then you report the salvage sale separately. Then insurance or other reimbursement will reduce that loss. The single identifiable property, or SIP, is often a timber block or some type of account. So in plain language, the IRS is asking what property account was actually affected and what was its basis. So let's unpack the calculation steps. To calculate a claim, 3 numbers matter. First, fair market value before the disaster. Second, fair market value after the disaster. And third, your timber basis. A consulting forester can often help you estimate this before and after timber value using a cruise, existing management plan, timber sale data, and knowledge of local markets. IRS publication 547 says the fair market value decrease is the difference between the property's value immediately before and immediately after the casualty, and that a competent appraisal is generally needed to determine that change. The basis can be harder, especially if the property was acquired decades ago and records are incomplete, which is why old deeds, settlement statements, inheritance records, cruises, and past returns can be really valuable. Because basis is so important, the next few slides slow down and explain it. Think of basis as your tax investment in the timber, not what the timber is worth today, but what is in the timber account for tax purposes. Timber basis can increase through additional monetary investment, or it can reduce or be depleted through some type of sale or loss, but it doesn't just automatically increase because trees grow, prices rise, or inflation occurs, which may surprise landowners. If your woods doubled in market value, that does not mean your basis doubled. And if your basis is 0, USDA guidance notes that there may be no deduction even when the physical damage is real. So how is that basis established in the first place? Well, for purchase property, basis starts with the acquisition cost, but the cost usually has to be allocated among land, timber, and maybe other assets. So purchase price plus related costs such as attorney fees, title work, surveying, timber cruising, and forester costs. And then for inherited property, you've got fair market value at the time of death, but just a reminder to check current rules when spouses and jointly owned property situations are involved. Practical example could be if you bought 80 acres with merchantable timber, don't leave the whole purchase price sitting in land. A forester and a tax advisor can help allocate value to the timber. Purchased and inherited property are common, but not the only situation you might find yourself in. So if a timber property is gifted, the basis generally follows the donor's basis. That means if a parent gives woodland to a child, the child may not get a new fair market value basis just because the property has appreciated. So for plantations, we want to emphasize monetary cost reduced by any reforestation tax credits or amortization used. In practical terms, if a landowner planted trees and already used tax benefits to recover those costs, the remaining basis may be reduced. So just check to see if any preferential tax programs where the land was enrolled in before the disaster happened. And this is exactly why old invoices, cost share records, reforestation deductions, and past year tax returns are important. But what if those records were never set up? So many landowners never established a timber basis when they bought or inherited a property. But luckily, determining basis after the fact can be done by a forester. Just note that we have found the cost may outweigh the tax benefit if the acquisition was many years ago, because to hire a forester to do this kind of a basis determination does cost money. USDA guidance also notes that a landowner can use current volume, growth over time, and timber prices at acquisition to establish basis retroactively, but a professional forester's help may be needed. So don't assume it's impossible, but also don't spend more on reconstructing that basis than your deduction would probably save. We'll talk through an example that is for Michigan Forest Association's land holdings because we feel like it pulls these ideas together. So this example starts in 2015 with 874 cords and a timber basis of 17,325, which gives us a depletion unit of $19.82 per cord. By 2019, our inventory is 928 cords, and after a 254 cord harvest, 4,742 of that initial basis is depleted, leaving $12,583 or 674 cords. By 2025, thus, our pre-storm inventory was 708 cords with a depletion unit of $17.77. The storm, in fact, affected all 708 of those cords. We did a salvage harvest of 614 cords and 94 were destroyed beyond the ability to salvage. So this slide allocates 10,912 of basis to the salvage volume and 1,671 to destroyed volume, totaling 12,583 of storm-related basis. So the key implication is the salvage sale. The proceeds were 20,604 and the total basis lost from the storm of 12,583, which is a difference of 8,021. So in plain language, the sale proceeds exceeded the remaining basis. Because USDA guidance says salvage sales are reported separately from the casualty loss and IRS guidance treats reimbursements above basis as gain, this is a point for careful tax preparer review. The practical takeaway is that storm damage can still produce taxable salvage income if the salvage proceeds exceed basis and expenses. Once the numbers are calculated, the next question is where they go on the tax return. So for business timber property, you'll need Form 4684, Section B, and then Form 4797 and Form T for forest activities and basis tracking. Form 4684, Section B is specifically for business and income producing property and will require you to calculate an adjusted basis, reimbursement, and fair market value, and then gain or loss calculations. 4797 is where many business property gains and losses are ultimately reported. For landowners, the key message is don't fill this out alone. It's bring organized records to a tax preparer who understands timber. So next we'll talk about investment and personal use owner-related forms, noting that the limits can be different. So for investment timber, Form 4684 Section B and then Schedule A, but make sure to check whether itemizing affects this benefit. And for personal use property, you'll want 4684 Section A and Schedule A. And the $100 plus 10% of AGI limitation is just important to check with your tax preparer. Now let's talk about timing, when a loss can be claimed. In general, a casualty loss is deducted in the year the casualty occurred. But for a federally declared disaster, a taxpayer may elect to deduct the disaster loss on the return or amended return for the tax year immediately preceding the disaster year. So we'll summarize this as claiming it in the year that it occurs, or within a presidentially declared disaster, filing as if it occurred in the previous year by filing an amended return. And practically, this can matter if the prior year had higher income or if an amended return could create a refund sooner. So that decision, again, belongs with you and your tax professional. So next is the question many landowners ask first: what happens if I sell salvaged timber? So salvage is not required. Sometimes salvage harvests are unsafe, uneconomic, ecologically undesirable, but if you do sell damaged timber, that income has to be reported. Salvage income may be declared as capital gain if the holding period rules are met, and basis and expense may be deducted. USDA guidance also says salvage sales are reported separately and that gain can occur when salvage sale proceeds exceed adjusted basis and sale expenses, as in our MFA example. So for landowners, separating the casualty loss calculation from the timber sale reporting is important. They're connected, but they're not the same line item. So if salvage income creates gain, one possible planning tool is involuntary conversion. It's a tax concept for situations where property is destroyed or damaged and proceeds are used to acquire replacement property. Income may be used to purchase replacement property such as timber, timberland, reforestation costs, or at least 80% of a timber company's stock, and that the election must be declared to the IRS with the casualty circumstances and replacement property clearly identified. Standing timber bought with proceeds from timber downed by casualty can qualify as replacement property, and gain may be postponed if replacement property rules are met. The timing rules are technical, so this is another tax advisor conversation, not a last-minute decision. So to close, here are the main places to go for reliable follow-up information. This is worth saving. Take a screenshot or find the slide deck on the MFA website. It includes the National Timber Tax website, IRS forms and publications, USDA Timber Casualty Guidance, and a Forest Landowner's Guide to Federal Income Tax. My recommendation is to leave today with 3 action items. Firstly is to document damage. Second is to contact a consulting forester if timber value or basis needs additional evidence and support. And arguably the most important is to meet with a tax professional before filing. So let's end with the shortest version of today's message. To summarize, first, a timber casualty loss must come from a sudden, unexpected, identifiable event. Federal disaster status can be very important, especially for personal use property and timing elections, and documentation is essential. Photos, maps, cruises, management plans, appraisals, sale records, and tax records. And the deduction is usually limited by basis, not just by how bad the woods look after the storm. Finally, salvage income is its own tax issue and may create gain even after a damaging event. Once again, please don't treat this as legal or tax advice, but rather as a checklist for your forester, accountant, tax preparer, or attorney. Thank you very much.